Elecon Engineering is facing a massive paradox right now. A record-breaking order book is colliding head-on with severe margin pressure. Here is exactly what you need to know about their Q3 FY26 performance. This is a quarter of stark contrasts. While revenue actually grew by 4.3% to 552 crore rupees and order intake rose 7% to 701 crore rupees, the bottom line tells a different story. Net profit crashed by 33.1% to just 72 crore rupees, and EBITDA dropped over 23% to 109 crore rupees. The real engine of future growth is the open order book, which has swelled by 24% year over year to a staggering 1,372 crore rupees. Despite a mixed quarter, the company secured a strong future revenue pipeline, with quarterly order intake remaining robust at 701 crore rupees, signaling healthy demand. The Material Handling Equipment, or MHE division, is firing on all cylinders, driving top-line growth. Revenue for this segment is up 16.3% to 123 crore rupees, while order intake jumped 28% to 237 crore rupees. This momentum has pushed the open MHE order book to a healthy 561 crore rupees. The real challenge remains severe margin compression hitting profitability. EBITDA margins are down 720 basis points year over year to 19.8%, and PAT margins have dropped 730 basis points to 13.0%. This downward trend has been consistent throughout the fiscal year. This pressure was widespread, impacting both core segments. The Gear division EBIT margin fell 960 basis points to 18.2%, and the MHE division EBIT margin dropped 1,070 basis points to 20.2%. These sharp falls indicate systemic pressures rather than a single division issue. The squeeze started with gross margins, which fell by 610 basis points from 49.3% to 43.3%. Key drivers included an adverse product mix with more lower-margin products, pricing pressure from competition, and raw material costs increasing from 268 crore rupees to 313 crore rupees year over year. Rising employee costs added to the pressure, surging 23% to 59 crore rupees. This significant rise outpaced revenue growth, and the company lacked the operating leverage to offset the sharp drop in gross profitability, while other expenses remained broadly flat. Management acknowledges the near-term softness but highlights the 1,372 crore rupee order book and a robust inquiry pipeline across domestic and overseas markets as key drivers for future growth. They believe their leadership in industrial gears and upgraded manufacturing provides strong visibility. Looking at the 9-month trend, growth remains positive, with revenue up 13.4% and PAT up 24.8%. However, context is vital. The 9-month EBITDA includes a 25 crore rupee arbitration settlement, and PAT includes a large gain on an investment, meaning adjusted growth is actually lower. The path forward includes a reset of FY26 guidance. Management warns that revenue may be up to 5% lower than earlier indications, and adjusted EBITDA margins may be lower by up to 200 basis points versus prior expectations. Despite the setbacks, the structural growth story remains intact. Elecon maintains a strong balance sheet with a net cash position, historically high return ratios like a 26.8% ROCE, and a goal to reach 50% international revenue by FY30. Watch for the pace of margin recovery in Gears and MAT, the speed of executing that 1,372 crore rupee order book, and whether they can meet this newly revised guidance. Follow for more smart investing insights and deep dives into company performance.